The broadcast is now starting. All attendees are in listen-only mode.
Well, good afternoon. It's the 28th of January 2020 and our very first webinar for this wonderful new year. Lots of people attending. Thanks for giving us your time. It's actually unbelievable news. I don't know, really every month or every 2 months that we have the webinar, I look back on the performance of the portfolio and just got to wipe my eyes. We're now looking at 37% per annum annualized growth since we started more than 5 years ago. So I'll take you through the latest developments in the portfolio. But first, let's see how the tech is. And Stuart, my colleague, our managing editor here at Biz News, is the man who makes sure that we actually can all hear each other. Stuart?
Excellent, thanks, Alec. Always good to be here. As I said, all the best for 2020 to everyone listening. If you got a little high five button on your control panel, if you can hear my voice and see Alec's screen, just let us know. Looking good. Okay, great. Thank you for that comment. And we do like to keep it quite conversational as we go through. As Alec goes through the portfolio, it'd be quite nice if you guys just drop them in your questions, and I'll throw them at Alec at the right moment in time, and we can keep it sort of Q&A-ish, Alec?
Oh yeah, for sure. It works better the more questions we get. Sometimes I don't get through what I've prepared, but at least if we get questions, we can address the things that actually are of interest to the Biz News community. So, and there are a lot of you here today, so please do send those questions through as soon as you can. Right, Stu, everybody can hear, everybody can see. Apologies for what you're seeing on the screen with a little bit of ups and downs. I don't know, me and Microsoft. I'm on a Microsoft Windows computer now, but for some reason I can't get it to talk to PowerPoint, and I try to do PDFs, but whatever. We'll just put that on the one side. I'm sure you'll be able to see the action anyway, or the slides that I put together. And apart from that, the most important thing, of course, is that we can talk through to your questions. So, Stu, ready to go?
Yes, let's rock and roll, Alec.
Here's the portfolio, and as you can see, the value, I can just bring you down to the bottom part there. Portfolio value 2 months ago, at the end of November, we're at $405,000. January 2020, $440,000, and it could have been a whole lot better. There you see the rand. I mean, it's extraordinary. It continues to surprise me how this portfolio performs, but the rand value has gone from just over 6 million to now 6.5 million. And we started off with about 2.25 million rands when the portfolio began on the 5th of December 2014. As you can see, all of that in the box there. The performance in this period, in the past 2 months, we've really had some amazing jumps from Apple. I'm going to talk to that in a while. That has gone from $264 at the end of November to $309 today. Adobe, which has gone from $308 to $347, and Netflix, which has gone from $312 to $342. That's in the most recent period. Now, those are big jumps, particularly for Apple. As you can see, it's 18% of the portfolio, second biggest share in our portfolio today. And the rise since we bought it in the first place is 148%. Much of that coming last year when the share price was up 98%. I guess you look at it, you say it's now the most valuable company in the world. Can it keep going? Well, we've been betting on Apple because of the ecosystem that it has. There's now, at the latest count, 1.3 billion of Apple devices that are around. And the view we've always had and articulated over the years on this webinar has been that Apple's real value is not in selling iPhones, but it is in having an ecosystem and a closed ecosystem of Apple devices. As I mentioned right in the outset, I'm on a Windows computer today because it's in my studio, and for some reason Apple hasn't really got its act together when it comes to audio equipment and integrating with that. But I wanted to keep it nice and quiet and also give you some really good audio to listen to, a good quality of audio. So hence I'm working on the studio computer, which is a Windows computer. But outside of that, pretty much everything I do is to do with Apple. I've got an iPad, one of the latest versions that I use for taking notes now. It's a fantastic system when you just use normal old Apple Notes. We've got iPhones in our family throughout. Apple big desktop, what's called an iMac. We use the Apple iPods, and I could keep going. Apple TV, it just goes and goes. And now the value there for Apple is the ecosystem that everything talks to to each other. For instance, if I want to transfer a file from one device to another, there is a special system in Apple which you click on, and you just, as long as the devices are within, I suppose, stone's throw of the next one, they move across. You send it from one and it comes to the other, and it's all part of this ecosystem. And so as you get the ecosystem together, and as that grows, Apple can then start selling us products which it can make higher and higher margins from. Always when you add the product, it's like acquisitions, bolt-on acquisitions, they always tend to have a much higher margin than when you start from the beginning. So it's not just me who thinks that. Warren Buffett has got his biggest, he's got 25%. In fact, now it's over 25% of his portfolio, but he's got this huge $150 billion share portfolio in Berkshire Hathaway. And more than a quarter of that is invested in Apple. And in fact, in the last 2 months, November to now, Warren Buffett's shares, he's got 252 million Apple shares. We've got 257. So just multiply ours by about 1 million, and you'll see what he owns. In the last 2 months, his equity that he's put into Apple went up by $11.3 billion. Who says the 89-year-old has lost it? He certainly knows where to put his money in. And whenever he decides on something, you got to be really dumb if you don't follow him. So we've done that. In fact, we were in Apple before the OBOS from Omaha, but we stayed with it at a time that it didn't look that happy. And it's now shown us in this past quarter in particular, it's had a fantastic run. Also in this quarter, we had Naspers, which did a whole lot better, but unfortunately Richemont has just been hit. Just the last couple of days, it got hit by the coronavirus in China. More than 100 people are dead now, and there's concerns that this could spread elsewhere. China's in complete lockdown, and the impact on that has been on Richemont. Not surprisingly on some of the other Chinese shares, but we'll talk about that in a moment. So there's the updated portfolio. The way it works is you can't come to us at BizNews and give us money and say, please put this into the portfolio. This is a portfolio that is a model. And just at the risk of repeating myself to those of you who've been following us for a long time, we did at one point have a portfolio that you could invest in. That was with Easy Equities. But some time ago, it became quite apparent to us that the size of the investments that were going into the BizNews portfolio was of such a nature that I was going to have to give up BizNews and start managing money. And that's not my intention. I'm not a money manager. I'm a media entrepreneur, editor, journalist, if you like. But it is not, this is a model portfolio. So in other words, you can look at that, you can say, oh, this hot guy doesn't know what he's talking about with the Stanlib ETF. I don't want to put any money into that. But I do like what he says about Microsoft. And then you can allocate your percentage of the portfolio according to what suits you. If you want to just follow our portfolio, then you would put 21% of your money into Amazon, roughly 2/3 if you want to break it down into offshore, and about 1/3 into onshore. So that's the purpose of this portfolio. It's a model. It's for something for you to invest in on your own account. And then every 2 months, we have this webinar where I can update you on how the portfolio is performing. And from time to time, we do make changes, but we try to keep those to a minimum, because every time you make a change, you trigger a tax event on the one hand. You also trigger costs in trading. And as Warren Buffett, and you can hear he's one of my heroes, says that the idea of buying a share is do your homework first and then hold on to it forever. If circumstances change, obviously you should change that as well. There you can see now on the screen that the individual performances have been quite spectacular. The rand, when we started, has depreciated by 29%. So in 5 years, 29% is not exactly Zimbabwe's dollar style, is it? So often I think you need to get perspective when people start talking about the weak rand. Sure, it is down by about a third in 5 years, but it's hardly collapsed at 14.58, where it is at the moment, from 11.27 in December 2014. But look at Amazon. If you take Amazon out of this portfolio, the performance would be, I guess, pretty ordinary. It would be a bit better than the overall S&P 500 index, certainly, but still, Amazon has been by far our top performer, and the stock that is our biggest share in the portfolio. As you can see, the value in rands per share has now soared from under 4,000 rand to over 26,000 rand in those 5 years, and that has the ability to substantially lift any portfolio with those kind of numbers. But Apple and Microsoft have also done exceptionally well. Berkshire is our proxy, if you like, for the S&P. And then Adobe and Netflix have been fantastic performers. We've only had them in the portfolio for a relatively short period. If you have a look at that, Adobe was bought in mid-2018, and Netflix was only bought in September 2019. So they have substantially outperformed the S&P 500 index as well. What we did decide to do a little while back, in fact, towards the end of last year, it was September as well last year, when we restructured the portfolio, you can see we brought in Naspers, which has hardly moved, but not to worry, a good long-term bet there. The StanLib, it's now called the iInvest Top 40, so that gives you a bet on the South African stock market, and that's been flat. And then Richemont, which had a great run up to 125 Rand a share, but it's now come back to 110 because of the coronavirus. So we've got a third of our portfolio on the Johannesburg Stock Exchange, on the JSE, and we're very happy to have it there, because the view that we have is that South African stocks are very, very cheap at the moment. So we'll be looking for more opportunities in time. There you can see on the screen, the Rand dollar has not really changed that much when you look at it relative to the stocks that we have. The 3 South African stocks only bought in September last year, and along with Netflix, we made a good idea to go into Netflix, but the South African stocks haven't done much. But you can look at the performances of the others there in this graphic. Shows you a big story. Stuart, is there anything that we can address now before I go into the individual highlights of the last 2 months?
Sure, Alec. There's a question from Hugh. He just wants to ask if you recommend the same share weighting for someone buying into today.
Definitely, Hugh. It's a good question, because clearly the stocks change from time to time. My view on this is the most important thing when you do buy into the portfolio is to stagger your purchases. The worst thing you want is to go and buy in at a time that the rand is particularly strong and the stock that you're acquiring has shot up for some reason, and you can then find yourself in quite a lot of problems in trying to get a reasonable or a decent return. You can't time the market. Sometimes you get lucky, as we did with our Netflix purchase, but you can take out a lot of that risk of timing by staggering your purchases over 3 months. What we did in September was we restructured the portfolio entirely and then made it into the BizNews share portfolio rather than the offshore portfolio, because we then brought in South African stocks, and then we bought 100% of our holding at that time. But generally, what we've done since inception of this portfolio, if we've made a decision to buy a particular share, we will buy it over 3 months. So today's the 28th. If you were to put 21% of your, or so there's Apple's on the screen, 18% of your portfolio into Apple, you'd buy divided by 6 3s are 18. Yeah, 6% of it today, or one third of the number of shares that you want to purchase. That's easy enough to work out. 1/3 today, 1/3 on the 28th of next month, and the final third on the following 28th. It's not an absolute science. Who knows what the rand or indeed the Apple share price will do between now and then. But it does give you the protection that you're not going to be buying on precisely the wrong day. The overall portfolio, though, I'm very comfortable with the way that it's structured. It's heavily weighted towards Amazon and Apple, but they are stocks that over the years I've got to know pretty well, and not always been in line, my thinking, with the thinking of the market generally. But that's fine, because your idea is that you should be doing your homework on the shares, understand why it is that you're becoming a co-owner of that company, and then the noise that always comes and washes over us will actually not affect you. It's a bit like living in South Africa. You know why you're living in South Africa. You know, by doing your own research into the country, you can understand what view you're taking on the country, if you take a longer term view on where we're going here and where the governance is going, etc. And then when the drama queens dominate the headlines, you ignore them, and because you actually have a pretty good solid understanding, having done your own homework. Share investing is very similar.
Thanks, Alec. Just before we go, there's obviously a question on the coronavirus. Fred wants to know, why do you think it had such a substantial impact on Richemont, but less so on other stocks? Does this mean the fundamentals for Richemont still make sense?
Yeah, Richemont is heavily exposed towards China. It's its biggest market now, and China's in lockdown at the moment. And when you have, the more money you have, the more uncertain things become, the less you spend. It's just that simple. And so people who are analyzing this have assessed that if the coronavirus were to continue, then the luxury end would be hardest hit. And hence Richemont is one of those stocks that's come under pressure. We've seen very little move, for instance, in Tencent, a little bit, but nothing serious, because you don't have to really go out to the shops to go and buy anything that Tencent offers. In fact, you definitely don't have to. It all comes through your WeChat app, which 900 million Chinese have got on their phones anyway. So that's really the reason why Richemont has been exposed. It's Mr. Market at it again. Remember, Mr. Market is this manic depressive individual who always exaggerates on the upside and the downside. The coronavirus, 100 people are dead, and that's really serious. And there are thousands who have been affected, and millions apparently who've been impacted because of the shutdowns of airports and travel routes, etc. So, of course, all of this isn't helped by these sensationalistic headlines. But I just point you back to what happened on our continent with the Ebola virus, where that was also a huge panic. And then after a period of time, the authorities managed to get it under control. Many more people died in the early stages of the Ebola virus than are affected in China. But one death, of course, in these issues is too many. And I guess every time that there is a virus that mutates in this way, it could become something sensational and something that affects many, many people. We've had these through history. And as a consequence of that, I guess skittish investors, and Mr. Market is amongst them, are deciding who the losers would be in that scenario and just adjusting the risks accordingly.
Thanks, Alec. I suppose this one was going to come up for the new people. Greg just wants to know, what are your views on Tesla? Because I know we've been in Tesla before.
Yeah, we love Tesla. We love Tesla, and then we got pretty skittish and pretty scared of it because the volatility was huge, and Elon Musk was, it was almost like he just found a different brain all of a sudden. He was fighting with everyone. He was on Twitter all the time. And we took the view that when you invest, you want to sleep at night. And Tesla is one of those stocks that you don't sleep so good because you're either terribly excited about what's happened today or terribly depressed because Elon is fighting with the SEC, or Tesla hasn't met its targets and he's having to sleep in the factory every night and so on. So it's one of those high beta shares. Investors, the professional investors, will tell you that stocks have got either a high beta or a low beta. And what that means simply is volatility. And Tesla is a highly volatile stock. It's done incredibly well in the last little while, worth over 100 billion in market cap. In fact, worth as much as the next two biggest motor manufacturers combined. So there's a lot of hype in it. What a couple of things worry me about Tesla. One is the volatility. The second thing is that it really is a one-man show. If for some reason Elon Musk were to tire of the challenge, or heaven help us, get knocked over by a bus, Tesla just, the share price would probably collapse, because there's a lot of what's built into that is Elon Musk's brilliance and his genius. And the other thing that worries me is that it's highly favored by millennial investors who aren't necessarily buying into the stock because of the fundamentals or the financial fundamentals. They are buying in because he's a bit of a cult hero. And that's really the whole Tesla story. He's a genius. He might pull off what nobody in history has managed to pull off before. But on the other hand, it's going to be a wild ride. And from our perspective, investing shouldn't be a wild ride. Investing should be stable and predictable, whereas Tesla is anything but predictable. I hope that answers the question. It doesn't mean that you shouldn't buy the shares if you like Elon and the product. Wow, I mean, Tesla cars are just extraordinary, and he's making great advances in batteries, but do know that it'll be a wild ride. And when one looks at a portfolio like this, you could have a few. And in fact, at one point, I think we had about 4% of the portfolio in Tesla. So you can have a few of those shares just for a bit of fun, but it shouldn't really, when you're dealing with widows and orphans and funds and the investing public, the retail investor, we're trying to get to a point where things should be a little more predictable.
Excellent, thanks, Alec. Chaman wants to know, is it not easier to buy a technology ETF than the top 6 individual shares?
Yeah, it is. It is. And that is an alternative option. If you, I think Signia have got a ETF that's done particularly well by focusing on those shares. We just believe, though, that individual investors or retail investors should be taking more of an interest in their individual investments. We think at BizNews that it's an exciting story. Every company that we have in this portfolio has an exciting story, and if you follow that story, you don't have to follow too many of them. There's only less than a dozen shares here. It also adds value to your life as well, because you've got something concrete and real to understand. My feeling on all of this as well, on buying individual shares versus ETFs, is you could probably balance your portfolio between the two. And if you're really not interested in the stories of the companies or how the companies are progressing, then just stick with ETFs. But it's the greatest game in the world, share investing. There are thousands and thousands of shares that are listed. We in South Africa were always restricted to about 300 or so on the Johannesburg Stock Exchange, and we got to know those very well. But when you open your mind to what's happening in other parts of the world and what a big place we live in, we're only 0.5% of global GDP in South Africa. So there's 99.5% of global GDP that's out there that we aren't participating in if we just invest in this country. Now, the first step would be, I suppose, to take an ETF on some part of the world, but a much more interesting way is to identify individual companies that appeal to you. And an example of that was Adobe, which I'll put that up onto the screen now. I went to a conference that Adobe hosted in London, and I'd always used Adobe PDFs and Adobe Audition, which we use for our podcasts. And I'd heard, of course, about Photoshop. And when I started putting the blocks together, what Adobe had done, when you read the annual report, and in fact, the latest annual report came out on the 21st last week, which makes very good reading. It's 140 odd pages. And the American annual reports is quite prescribed, the information that they have to give to the stock exchange, quite in depth as well. But what I liked about Adobe, because I look at our own business as well, and they have moved from paying or giving away a lot of stuff for free, but on Photoshop and so on, selling it as a one-off to people, to now a recurring revenue model. And in the annual report, you'll see that of their just over 11 billion in revenue that was generated in the fourth quarter of 2019, sorry, in the whole of 2019, 11 billion, 7.3 billion, about 2/3 of that is recurring revenue. Now, what a fantastic business that is. So they've moved across from a potentially volatile revenue stream to a recurring revenue stream where I don't even bother about it anymore. When all of our licenses to Adobe Audition every month, it comes off the bank account. And I know it's coming off at various times because we've taken out the licenses at various times. But Adobe is very happy because the marginal cost of that is zero to them. And if they keep getting that, they can spend, as they do, nearly $2 billion a year on research and development to make it better and better and better. So everybody wins in that scenario. I kind of got the understanding when a friend of mine told me to read a book called The Automated Customer, and then had a look at what companies were starting to implement that. And hence we invested in Microsoft, because Microsoft moved to the model that Adobe has also moved to, where they, in the past, used to have you go into a shop and buy your CD or whatever it was. With the cloud, Microsoft could do the automatic updates onto your machine of Office, Word, Windows, and so on. And that way, you're paying Microsoft 360. You can pay monthly or you can pay annually, but it's a recurring payment. And those are the business models of the future that are being appreciated by investors, because recurring revenue is valued much higher than one-off revenue. Adobe is one of those. So I went to this event. I'd already had that in the back of my mind, that this is a company that's moving in the right direction. I saw the products, was blown over by its strategy of helping those in the media industry, for instance, digital media, which is a big part of their work, to take on Facebook and Google, who've got 2/3 of the world's ads, digital ads, which can't continue indefinitely. Adobe is there supporting the publishers who are fighting back, if you like. They might not win, but it's like a gold rush. The people who are providing the picks and shovels are always winners. And in this case, Adobe is providing those picks and shovels. And you can see on this share price graph, since November 2019, it was down just above $250. It's now sitting at nearly $350. So Adobe is an example of a company that I was exposed to. I then went and did my homework, and I'm following them, and I'm following their developments and their progress, and I'm very happy to be a co-owner. When you buy an ETF, you're not a co-owner of the company. You are buying a parcel of shares that has been mathematically sorted out for you. It doesn't mean that it's a bad thing, but share investing is so interesting, and it can be so exciting. But of course, it can also be so rewarding. And those are the philosophies that I would like the business community anyway to embrace.
Thanks, Alec. Just a question from Meryl on Amazon. She asks, would you buy it now, or has the price run too hard?
Meryl, I love Amazon. It's having lived in the UK for 3 years and seen how unbelievable their model is, and how you do move away from going to the shops and buying the stuff online. And in the rich north, it's just a standard practice. We in South Africa are not that used to it yet. I know Takealot as part of MySpace is doing quite well, but Amazon, in its core business, in the marketplace for products and goods, is just so far ahead of everybody else that it has a long-term trajectory, which is very difficult to see how it's going to get knocked off it. The other part of Amazon, of course, is that they were 7 years ahead of their competitors in investing in the cloud. And that has given them an advantage that is almost impossible for the competitors to catch up on. The Amazon Web Services, which incidentally has got a big installation here in South Africa in Cape Town, which is why a lot of our internet is pretty quick when it's hosted with Amazon Web Services here. That is part of the global empire, and that being first to market has given them an extraordinary advantage in terms of margins and the ability to have captured the lion's share of that market. The competitors are coming at them, Microsoft, Google, even IBM recently with the purchase of Red Hat. But Amazon has got the pole position, and those are two very, very big markets that they so dominate. Also, I just love their strategy. When you read the shareholders' letters by Jeff Bezos, he says every day is day one. You don't come to work at Amazon and just go through the motions. What are we going to do differently today? How are we going to put our customers onto a pedestal? How are we going to make sure that our customers have a better experience? And that's aligned with some of the smartest business people. I remember when I was running MoneyWeb, when we were listed in the stock market, every year I would write the chairman's letter for shareholders to share what had happened. And the one paragraph that I always included in there was Warren Buffett's recommendation or advice to say that every day we do little things within Berkshire Hathaway that if you look at them from the outside, you wouldn't even notice them. They're imperceptible. But those little things will eventually add, and incrementally over a period of time, they broaden your moat. Now, it's the little things that we do also at BizNews, for instance. If we get people send us emails to support@biznews.com, we are obsessive about getting to that quickly. One of the team, the whole team has access to it, and someone on the team will pick it up and then respond so that we keep just delighting our customers. And that's what we've learned from Amazon. Amazon is about, it's always put customers first. How can we get the product to the customers at the cheapest and the best possible product? And how do we check that we don't let people into the ecosystem, bad actors who are going to rip off our customers? You can't be perfect in that, but they certainly are doing the best they can. And that is a irresistible model to me. So Amazon's share price has done very little in the past year. To be buying it today is what you would be paying a year ago. Some of the concerns that they have is Donald Trump doesn't like Jeff Bezos. And the reason for that is quite easy to understand. Jeff Bezos, in a personal capacity, bought the Washington Post, and the Washington Post is one of the great newspapers of the world, and it has not been supportive of Donald Trump. In fact, it's been exposing his peccadillos at every opportunity. Now, the Washington Post has got a very proud history and record going back to when the Graham family owned it. And another one of my heroes, Catherine Graham, who was the publisher there when they went against all the other newspapers and actually took on the Nixon administration over Watergate and led to the end of Richard Nixon's, being impeached from that country. But Donald Trump doesn't like Bezos. He doesn't like the Washington Post. And there is a concern amongst investors that he will do what he can to hurt Amazon. He hasn't managed to do much yet, but yet is the prescriptive word. So if Trump gets beaten in the election, I mean, I know it sounds crazy, but you'll probably find the Amazon share price rises quite substantially as a consequence of that, because they won't have Trump on their back anymore. But the US is only part of the whole Amazon story, in the same way as it's only part of the Netflix story. And we're very lucky there on Netflix. We've been watching this for a long time. So, Stuart, can you see everything okay?
Yes, Alec, everything's good. We're on the Netflix graph at the moment.
Okay. We've been watching this stock for a long time, and I love their model. To me, it's irresistible. It's not a fight against the other streamers, Disney and Hulu and the others who are coming in, Comcast, who are coming into that market, Apple, but it's actually a fight against linear television. And if you think about it logically, it's like radio versus podcasts. why should I be sitting listening to a radio show at a particular time of the day? And I know I'm going to miss part of it because someone's going to phone me or I'll get distracted by something else. When, if I want to consume that media in particular, I go online to a podcast and listen to the podcast at the time that suits me. Well, similarly with television, Netflix is giving us the option to watch anything we want to, and it's got a huge library and a lot of original content at the time that's convenient for us, rather than having to sit in front of a television set and wait for your favorite show to come on at that point in time. That's why we have this term called cutting the cord, where people are going and now consuming Netflix because it comes through the cloud, where Amazon, of course, is strong. Netflix is a big customer of Amazon's, and through the internet, and you can then consume that entertainment in a very different way to what linear television is. It's a little bit like going from a newspaper to online consumption of news. And Netflix maintains, and I watch their quarterly investor reports. It's quite nice what they do there. They bring in a analyst from a company called Guggenheim, and then they have their top 5, I think it is, executives, including Reed Hastings, the chief executive, and then he poses questions to all of them. And they use something that's very similar to a Google Hangout. So it's not really that sophisticated. But as the one guy speaks, his face appears on the screen. Go and have a look on YouTube. It's really, really worth watching. And as you listen to them, and I obviously did a lot of research before we finally jumped in around $250 for this share in September last year, when it had that dip, as you can see here. That was as a result of, in fact, I can show you some other graphs on that. If you have a look here, in September last year, the growth, if you can see that graph on your screen now, this is the Netflix revenue by quarters. So it's a very steady growth. But in September, there was concerns that it hadn't grown enough. And the market didn't like it because Netflix itself was thinking the growth could have been higher. And the share price then came down. There was concerns that it was going X growth. It was far too much focus on just North America rather than the world. Because if you have a look at the world, look at that, they're now nearly 180 million paid subscribers, and it keeps rising. And why does it keep rising? Because they've got an irresistible model, and they're only charging, in South African terms, 130 Rand a month, one movie ticket. But they are fighting against linear television. They are disrupting linear television. And that's the reason why Netflix, to me, is not at risk from the other streaming services. It's really disrupting it's eating an elephant that's out there. And that's a similar situation that you find in many other businesses that are what we call exponential businesses. So keep focusing on that as the reason. Is this a company like Adobe, which in the last year, its revenues were up by 23%. Netflix in the last year, its revenues were also, well, in fact, year-on-year revenues are up around 30% year-on-year. So this is exponential growth. If you just take out your Excel spreadsheet or your Google spreadsheet and you put in there, just work it out for yourself. If you escalate a number by 20% a year or over 20% a year, you very, very quickly get to a mouth-watering result. And that's what we're seeing here with Netflix, for instance.
Thanks, Alec. There's a question from James. He gives you a thumbs up for the point about subscription businesses. But he says, apart from Berkshire, all your US shares are subscription based. Are there any subscription businesses in SA or Europe that you would consider?
Wow, that's a good question. I would, if I could find them. I think the businesses that are going to do well into the future are those who've got fantastic business models, like Netflix, who are giving us. I mean, it's hard to believe how amazing the offering is from Netflix. And you can sit down there, and if you are that way inclined, you can binge watch a lot of the content that, well, many of the series is. Netflix spends billions of dollars now in producing its own original content that you can get to. And you pay 130 Rand a month or $12 in the United States. If you're in the north, in one of the rich northern countries, and you want to order, because we actually did this, Jeanette needed a marker for the whiteboard, and she ordered it on the one day. I think it cost $2 or $3 or something. It arrived the next day. It was delivered to us. That's incredible customer focus. Now, if we had similar customer focused companies in South Africa who were on that kind of a model, a subscription model, I would be an investor, like I am in BizNews. I think that's one of the things we're trying to replicate as much as possible, that people around the world have shown is the way into the future. Because when consumers are clever, and no, sorry, they're always clever, but when consumers are informed and able to communicate, then they become an incredibly powerful force for good or bad for your business. And if we could find a similar type of company, and I'm sure they do exist, I mean, of course they exist, in South Africa or Europe, it would be the kind of company that I would like to be a co-owner of. I'm just thinking off the top of my head, though, the retailers in South Africa don't really stand out as that anymore. Woolies is Woolworths is, I suppose, the one that you could think of as being more customer focused than the others. There's a company in the United States called Costco. I've got a really good friend who's out from the US this week, and he was telling me just how incredible their service is and how they at Costco, which, by the way, Charlie Munger, who's Warren Buffett's partner, is a director of. Costco put a 20% markup on everything. That's it, 20%. And then, so if you want to go and buy yourself a suit of clothes, you can get it there 20% markup, or if you want to buy yourself a marker for a whiteboard, you'll also pay a 20% markup. But they make their money by you being a member of the Costco club, a little bit like Macro does in South Africa, I think. But the comparisons between Macro and Costco kind of end there. So let's look around. Let's try and find those subscription model businesses like a Costco and like some of those that we've put on here. And if we see them in South Africa, then it is certainly a place that we should be doing our homework on and potentially investing in.
I was going to say, Alec, would a MultiChoice not sort of fall in those lines? I know it's not just the same type of business.
I think the problem, it's a subscription business, which is great, but it's being massively disrupted. If you just look at that, what do I watch on MultiChoice? Honestly, sport. If the sport were to be provided by an alternative supplier, I don't think MultiChoice would be getting my 1,000 Rand a month. And that's why the MultiChoice future has been brought into question by quite a lot of investment analysts. Would I rather be investing in Netflix or MultiChoice? Well, Netflix at $130 and the smorgasbord of opportunities or consumption that it gives me. I just watch Netflix a whole lot more than I watch MultiChoice, excepting, as I say, for sport. And I mean, with a cricket, you can take that chunk of sport out now. So come on the rugby season, maybe I'll feel differently about MultiChoice then.
That's sure. Alec, there's a question from Ed. He says, should we be looking at the health sector as a defensive play for a potential recession?
Ed, I like your thinking, but I'm coming from a different angle. If you look in South Africa, the healthcare sector has been under a lot of pressure because of national health insurance, or the proposal by the ANC government that they will introduce national health insurance into the country. Now, by any measure, as an emotional human being, I would love to see everybody getting the same standard of health. As a capital allocator, government has proven to be absolutely shocking. So you can be almost guaranteed that if it does that, it's going to mess it up. in the same way as it's messed up, and it's not just this government, it's every government around the world, is not very good at allocating capital, because the incentive system that is created for public service is very different to that which is in the private sector. You don't have to go into the philosophies of it. But if you can remove that scepter or guillotine that is over the heads of the healthcare industry in South Africa, I'm sure those companies would thrive. I'm sure they would invest more into the future, and they would benefit greatly. Again, as mentioned earlier, if Donald Trump does not get re-elected in the United States, that Amazon would perk up, that share price would benefit. You'll see that if the South African government comes to its senses about national health insurance, which the economic realities surely will do at some point in time, then the stocks that have been depressed as a consequence of that, and there you can look at all of them: Mediclinic, Life Healthcare, Netcare, of course Discovery, which is a fantastic, amazing business, Discovery, and incredibly smart people who've put it together, world first in many ways, in what they've been doing with their behavioral economics and implementing that within their product line. But they are not performing well, or not getting the premium that they deserve, because of the issues that are faced through potential national health insurance. So if you want to look past that, if you want to say that eventually people do come to their senses, then as a defensive play, it's got to be the one to go to. Is there further downside if national health insurance comes in? That's a question I suppose you've got to ask yourself, because the intrinsic value of most of those companies is much higher than the stock, than where the stock is trading at the moment. And I guess even it were NHR to be introduced, it would probably not hurt them or not hurt the share prices much more from the already very depressed levels. So I think you're onto something there, Ed.
Thanks, Alec. Dave just wants to know any thoughts on the three stocks: NVIDIA, Google, and Comcast.
NVIDIA is one that I haven't got to understand well enough, so I'll pass on that one. Google, we used to have in the portfolio. I got a little bit concerned when they were being hit with fines left, right, and center for antitrust practices. They do also completely dominate, along with Facebook, the digital advertising space. Whenever this happens, when you get these massive concentrations of power in any sector, especially if they were American companies, they eventually do get broken up, or they do get punished in some way, or they get legislated and turned into utilities. That happened very aggressively in the 1920s, and Google must be hoping and praying that Elizabeth Warren, who's one of the front runners amongst the Democrats, doesn't beat Trump in the next election, because she's promised to really nail companies like that. So Google is it's doing things. It's got a dominant position in a market, too dominant a position in a market for me to sleep comfortably at night. I don't know what's going to happen tomorrow. Maybe the Europeans just slap another huge antitrust fine on them, and they've already fined Google billions and billions of dollars. That would be my take on that one. It's just too risky. I mean, when you look at the numbers, it's not risky at all, but the outlook is just not secure enough to invest in it, from my perspective. What was the third one, Stu?
Comcast, Alec.
Okay, Comcast is a huge media player. You might know or remember, this is the company that had a punch up with Disney in the fight for the Murdoch assets. Comcast eventually ended up with Sky. It was beaten with 20th Century Fox. It's a massive company, family controlled. Seems to be a very well-run media business. It's exposed through NBC. I know the company. I don't know the valuations at the moment, but I guess it's one to perhaps do a little bit more research into. I think we're getting pretty close to the end of the webinar. I just wanted to bring this graph to your attention. The coronavirus, as we discussed earlier, has influenced and has a big influence on certain of the stocks. But you can see here's Tencent, which has gone up substantially in the past couple of months. Tencent's important to us in South Africa because it is a stock that Naspers is heavily invested in through now Process. And the decline in the share price since the coronavirus came through is relatively speaking not that serious. Naspers was something else I wanted to mention in the webinar today. It might have escaped your notice that they sold 22 million Process shares last week to raise 1.5 billion euros. In South African terms, you can near as damn it to 25 billion rands. And that money is all going to be used to buy back Naspers shares. Now, share buybacks have been extremely successful for shareholders, for share owners, for Apple and even Adobe, which actually has done a big share buyback program. And so there's no reason to believe that this won't support the Naspers share into the future. It's a big stock in our portfolio, but with 24 billion rands, if you want to be precise, that's being brought back into South Africa from the sale of Process shares, and it's really a very small part of their holding. I think about 1.5%. They still own 72.5% of Process, so it's a bit of a shaving. But the reason that they've done that Naspers has done that, is the discount between Naspers and Process is excessive, and there's already another discount between Process and the shareholding in Tencent. So you see Naspers trading at like a 40% discount to Tencent. So why would you buy Tencent shares if you can get Naspers at 40% cheaper, particularly if you're South African? So that's a little bit of good news for Naspers as well. Just mentioning on that share buyback, to go back to Adobe, as you can see, is one of my favorite stocks at the moment. Adobe has invested $1 billion in it's $160 billion market cap company. It bought back $1 billion of its own shares in 2017, $2 billion of its own shares in 2018, and $2.75 billion of its own shares in 2019, and that has helped. And it's a little bit like Apple. You can see when Apple's share buyback program and its dividends started kicking in, and there's a company sitting with over 200 billion in cash, now suddenly that penny is dropping for people, and Apple's had a stonker, as we spoke about earlier, in the past couple of months. That's about it for our webinar for today, Stu. Unless there's any particularly important questions that you'd like to throw quickly in the next 2 or 3 minutes, that just to put the portfolio up for us there. You can't believe that we're going to grow at 37% annual compound for the next 5 years. It just, those you'd be laughed out of any room if you said 5 years ago that this is what this portfolio would achieve for us. But we do believe that we've got a really nice spread of about 1/3 in South Africa and 2/3 offshore. All the offshore stocks, with the exception of Berkshire, are what we would call exponential shares. That's a subject for another day. But the world seems to have moved towards exponential, or understanding the value of exponential equities rather than old style incremental expertise. And all it means really is exponential are those companies that can grow at 20% plus a year.
Thanks a lot, Alec. There's no more questions on our side, but always fantastic hour of discussion. I think it was quite nice, the Q&A today, so it's lovely.
Yeah, thanks very much, everybody who did pose those questions for Stuart. It does make it a lot more lively. Stu, how are we going to be handling this as far as the publication on BizNews Premium is concerned?
Oh, no, all good, Alex. So we'll wait for the video to sort of process, and then we'll publish it on the website later this afternoon with the actual PowerPoint of your presentation for people who'd like to have a look.
Perfect. Well, thanks again, everybody, for attending today, and I hope that you got value out of it. And may 2020 be a peaceful and prosperous year for the entire BizNews community. Till the next time, from Alec Hogg, cheers.